Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at Nvidia and Alibaba ahead of their upcoming earnings releases later this week. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So quickly, before we jump in, the S&P 500 is now resting just below its February highs as of early trading Monday morning, and the NASDAQ is right back near its recent records as well. We saw Tesla surge over 7% Monday morning, putting them on track for a new record close as well. Their shares have more than quadrupled in value this year, making it really one of the big success stories of 2020, along with lots of other big names in tech we've talked about on the show, and most of you have heard about so far in the 2020, and especially this comeback off the market's March lows. And then another big winner early Monday was the first stock we're going to talk about today, and that is Nvidia, which trades under the ticker NVDA. Its shares have enjoyed really a serious ride off the market's bottom. They're up 130% from March 23. That crushes the likes of Zoom and Amazon and fellow semiconductor industry standout Advanced Micro Devices. And this includes another 6% jump Monday morning to see it hit brand new highs. So now Wall Street is awaiting the release of their second quarter fiscal 2021 earnings results that are due out on Wednesday, August 19th. So this upcoming Wednesday. So we're going to just go through Nvidia and then see what to expect from the earnings, and then maybe give some perspective on what the stock could do going forward. So Nvidia built its reputation as a graphics processing unit power that served the ever-growing global gaming industry that is really expected to expand from around $160 billion this year in 2020 to over $200 billion by 2023. So it's an ever-growing market. Gaming is getting bigger, from mobile phones to PCs to consoles. The firm's gaming unit was by far its largest revenue contributor for the last several years, and farther back than that as well. But its data center business is catching up quickly, and this has really impressed Wall Street, and this is why the stock has been on such a tear recently. The company's successful expansion into growth areas such as data centers, cloud computing, and artificial intelligence is poised to help the company continue its impressive growth. So if we look back, its data center business soared about 80% in the first quarter, from $634 million in the year ago period to $1.14 billion. So some really big growth in the first quarter that unit brought in over $1 billion. The company also easily beat our estimates back in May, with total revenue up 39%. We should also note that in April, the company closed its $7 billion acquisition, which was its largest ever, of Mellanox Technologies, and that is going to help it continue to expand into this data center business, cloud computing. And we should note that its new architecture is set to play a key role within AI-focused chips and cloud computing, which are both sort of the future of tech that we've been hearing about for the last several years, and they're really just starting to take off. So as we mentioned, Nvidia stock is up really big. So far, it's up 110% in 2020, which includes its massive run off the market's lows, and then about 190% over the last 12 months. So this crushes its semiconductor industry's 40% climb, and it's also, during this stretch, surpassed Intel to become the largest U.S. semiconductor firm by market value. And its recent climb is part of a much longer run that's seen it climb all the way from just $25 a share 5 years ago to its current price of $493 as of early morning trading on Monday. So from $25 a share 5 years ago all the way up to just under $500 a share for Nvidia. This run has, however, stretched its valuation picture a bit. Nvidia is trading at about 17.8 times forward 12-month sales, which comes in well above its one-year median of about 11.8. So 18 times forward sales compared to its median of about 12 times over the last year. So you could say its valuation is stretched, but investors have been willing to pay a premium for Nvidia for the last several years, and the entire tech space, at least these big players who have seen their share prices climb recently, their valuations have become bloated in general as big tech continues to prove its resilience to the coronavirus and its ability to grow during all of this. We should note that Nvidia does pay a dividend as well, but this big run up in its share price has shrunk its dividend yield to about 0.14% at the moment. So pretty small dividend yield, but it's still paying a dividend, which is good for a company that's also growing as well. The firm also has a pretty solid balance sheet, and it's part of an industry that sits in the top 20% of our more than 250 Zacks industries. So if we look ahead, our current estimates are calling for its Q2 revenue to jump about 42% to about $3.65 billion. This would top last quarter's growth and top the fourth quarter's growth as well. So a big quarter is expected from Nvidia in the second quarter. That said, it is expected to slow in the second half, with its full year revenue projected to jump about 33%. And then if we look ahead, we're calling for another 18% growth in 2022. So it's fiscal year 2022. In the semiconductor industry in general is a bit more cyclical. We saw Nvidia have sales decline last year, and then obviously it's bounced back in a big way. So seeing 2 years of growth is a good sign for Nvidia as well. So then the bottom end of the income statement, its adjusted Q2 earnings are projected to soar about 60% to $1.94 per share. And then if we look ahead, its overall fiscal 2021 earnings are expected to climb about 36% and then come in another 22% higher next year. So with all that said, Nvidia has clearly set a pretty high bar for itself, and there might be some near-term selling pressure, even if it posts strong results and has strong guidance, just because it's been on such a big run. It's trading at new highs, continuing to trade at new highs, heading into its earnings up so big, there could just be more pressure. But that said, lots of people thought sort of that same thing for Apple and some other big names in tech, but they showed that their blowout results could continue to push their stock prices higher and higher. We saw that at the end of last month with Apple and Amazon and Facebook, as investors are really just looking for anyone that boasts the ability to grow during these uncertain coronavirus economic times and for years to come down the future. So it's worth remembering, even though Nvidia has been on such a tear, if it is able to impress, it could, they just showed, some of these big names just showed that you could still climb even though it's been up so big. That said, it is currently a Zacks rank number 3 hold, and investors should note that its longer term earnings revisions are up since its last report, and it's consistently topped our bottom line estimates. So that's what we know about Nvidia heading into its upcoming report. And now we're going to move on to Alibaba, which trades under the ticker BABA. So unlike Nvidia, Alibaba has actually lagged the broader tech market during this run up since its March lows. It's fallen behind Chinese rival JD.com and its often cited US counterpart Amazon during the market rally. So it's up about 45% against roughly 65% climbs from those two names we just mentioned. So now heading into its release, which is set to come out before the market opens on Thursday, August 20th, investors are trying to figure out what to do perhaps with Alibaba. So we're just going to give the sort of the potted pitch for Alibaba and then look at what to expect from their upcoming report. Alibaba reportedly controls roughly 2/3 of the Chinese e-commerce market, and many on Wall Street have long been excited about the firm's ability to grow alongside China's growing middle class. Just for a frame of reference, China's middle class could hit roughly 550 million by 2022, and this is according to McKinsey estimates, which is far larger than the entire U.S. population, which sits at about 330 million at the moment. So that massive market gives Alibaba continuing room to grow as they can reach more of smaller cities outside of the really major cities in China as the middle class grows in that country, which is the second largest economy in the world at the moment. That said, its revenue climbed about 22% last quarter, with its core e-commerce unit accounting for about 82% of its total revenue. We should note that its annual active customers reached 726 million, up about 15 million sequentially, and its mobile monthly active users hit about 846 million for the 3-month period ended on March 31st. And Alibaba, like many other tech-focused firms, has been expanding its cloud computing business. That unit was up 56% last quarter to account for about 11% of revenue. So that growth far outpaced its core commerce unit, which just was up 19%. So 58% growth for its cloud computing unit. And then, like Amazon, it also has a digital media and entertainment unit that was up about 5% for the quarter. And it's worth noting that the Chinese market is the only major market, and really one of the only markets in the world that Netflix does not have the ability to get into at the moment. So they don't have as much competition from some of these big American streaming companies that have gone all over the world at this point at the moment. So that is worth noting. There could be some room to grow for that entertainment unit as well. Alibaba also topped our adjusted earnings estimates last quarter, and the CEO of the company thinks that it is clearly set to capitalize on the pandemic environment that he said has, quote, fundamentally altered consumer behavior and enterprise operations. So he thinks they're going to be able to do even bigger cloud computing business, and that more and more people are going to be e-commerce shoppers because of the pandemic. And the company was also able to meet its annual revenue guidance despite this more challenging economic environment with the coronavirus obviously taking its toll on Chinese economy as well as economies around the world. And we should note that the company laid out in their most recent quarterly results that they sort of reiterated what they said in last September, which was on their 20th anniversary as a company. They were setting out strategic goals for the next 5 years, which they hope to continue to what they call expand their globalization efforts. So to expand outside of China, they want to serve more than 1 billion Chinese consumers. And then this is part of a larger goal for 2036 that they want to reach 2 billion global customers. So that would be a massive jump from the about 800 something million at the moment. They want to get all the way up to 2 billion by 2036. And we should also note that Alibaba raised around $13 billion when it went public in Hong Kong this past November. And this is part of a recent trend that's seen JD and some other companies secure secondary listings closer to home. And this is also happening as more recently, tensions are continuing to grow between the US and China, but that's been bubbling for a while now as well. And another thing that's definitely worth mentioning is that the company's former CEO's next big venture stands to benefit Alibaba. So Jack Ma's Ant Group is a technology and financial services firm that owns Alipay, which is a widely popular mobile payments platform in China that competes alongside WeChat Pay. And the company announced back in July that it plans to go public in a dual listing in Shanghai and Hong Kong. And Alibaba holds about 33% stake in the fintech firm that's set to expand as part of this continually booming Chinese digital payments economy, where you can buy pretty much everything from things at just local street vendors, all via digital payments. So if we take a look ahead, our Zacks estimates are calling for Alibaba's June quarter or its Q1 revenue to jump about 25%, which would top last quarter's 22% sales growth. And then if we look ahead, this full year is expected to climb about 30% and then come in another 27% higher next year. So some solid and stable top line growth is expected for Alibaba, and its adjusted quarterly earnings are expected to climb about 5% to $1.52 per share, with its full year adjusted earnings expected to climb about 15%. So expecting bigger bottom line movement later on in the year for Alibaba. And then if we look even further ahead, we're calling for another nearly 30% higher earnings in 2022. So that's a positive sign that it's heading in the right direction in terms of its adjusted earnings. It's also worth noting that Alibaba topped our quarterly earnings estimates by an average of about 32% in the trailing 4 quarters, so it continues to beat our bottom line estimates. And like Nvidia, it is currently a Zacks ranked number 3 hold, and it sports a B grade for momentum in our style score system. It's currently trading at about 6.2 times forward 12-month sales right now, which comes in below its 1-year highs and not too far above the overall e-commerce market's average. And the stock sits at about 5% off its recent highs heading into its upcoming earnings release, which, unlike a lot of these other big tech stocks, it could give it some more room to run and maybe some room to break out if it's able to impress Wall Street with its upcoming results. That said, and it should also be said about Nvidia, it's probably likely prudent to wait if you're trying to play this for a near-term earnings. It's very risky. As I said, there could be lots of selling pressure just in general amid all of the uncertainty. But Alibaba and Nvidia are both certainly worth taking a look at as longer-term investments. And those people then might want to wait just a couple days to see how their actual near-term results shake out and what that guidance has in store for the company going forward before jumping into the stocks at the moment. We should also note, just as a broader market outlook, that Walmart, Target, and some other big names are also set to report their results later this week as we slowly come to an end of the Q2 earnings season. And we should also note that our Zacks estimates are showing that Q3 earnings outlook continues to improve slightly. So that helps us see why maybe the market continues to head higher, that we are seeing things start to trend in a more positive direction. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.